Alrighty, so we got the recording on the road. All right, guys, welcome to Deal or No Deal webinar, guys. This is Sam Kwak, one of the Kwak Brothers, real estate investor. Thanks for coming on board tonight. And for some of you guys out there, it's 5 o'clock Pacific time, 7 o'clock here in Central. Sun's going down, so it looks pretty outside. I live in a rural area, so it's really nice seeing the sunset from the window. All right, guys, we'll get the show on the road, and here's some rule of engagement. Typically, we can fit about 2 to 3 people in their deals. And in regards to jumping on board and sharing your deal, I just want to make sure that everyone understands that there's not going to be any addresses being shared. Try to keep pretty much any clue or hint as far as where the property is located. All we want to hear is basically the numbers, what your exit strategy is, what you're looking to achieve out of it. And what do you want to do with the deal? Which pretty much I'll write it on the whiteboard here, and I'll give you an idea if it's a good deal or not a good deal. We'll write it down. We'll go through the analysis together. We won't go too in deep, because if we do go in depth, we can spend hours and hours on analyzing the deal. So we're going to stick to the basic overview of quickly deciding whether if it's a good deal or not a good deal based on simple information. Another thing is that I just want to make sure that there's we're all adults, right? So there's no harassment, no swearing, no cussing, right? We want to be respectful as much as possible. Obviously this is the internet, right? This is getting recorded, so we all want to be careful what we say publicly to other people. You guys are watching this at comfort of your home. That's awesome. I want you guys to be comfortable and enjoy the experience of this webinar. Typically, the webinar will last anywhere between 45 to 50 minutes long, and I usually end it with a closing statement. So, guys, let's get the show on the road. Who would like to volunteer their deal? And we'll kick off with our first person. So go ahead and put your name down, or say me or whatever. Raise your hand on the comment section. I'll go ahead and unmute you, and we'll have an actual conversation going here. So go ahead, guys. First person to jump on board with the deal, or even just a hypothetical deal, we'll go through analysis. Anybody? Come on now. Oh, we got somebody here. All right, Savvy's got one, so I'm going to go ahead and unmute her. All right, Savvy, you're hot.
Oh, God. Good evening, everyone. Can you hear me okay?
Yeah, I can hear you.
Oh, wow. Okay, I'm nervous, so bear with me. So I've come across a deal or potential deal. So okay. It is 3 condos.
Okay.
2 of the condos are rented, and 1 is not.
Got it. Perfect. So 2 rented and 1 vacant condo. Now, as far as what is your exit strategy in this, Savvy? Do you want to keep it? Do you want to wholesale it? What would you like to do?
Definitely a buy and hold situation.
Okay. Got it. So we want to buy and hold. Okay. Basically, for those who don't know what that means, we're gonna rent it out to people, right? We're gonna keep it, be a landlord. Okay. So a couple things we need for buy and hold, and this is something that you can kind of follow almost every deal, but I'm gonna give you guys a rough sketch. So, Savvy, do we have an idea what at least the 2 condos that are rented, how much are they being rented for?
$725
each?
Yes.
What about the vacant one? Same thing, or?
The vacant one, it's just vacant. What happened is the former tenant just kind of blew out of there and trashed it.
Got it. So let's say, okay, so here's what we need to understand and find out. We need to find out what the market rent is for that. Now, are these condos all in a kind of the same area?
They're on the same street, actually.
Oh, okay. And I'm guessing all of them are pretty much identical, right? No, there's no change.
That is correct.
Okay, so we're gonna assume that they're all gonna rent out for $725 each, right? So that's gonna give us $2175 total gross. $2175 a month, and that's our what's called gross rent, right? This is the amount that we're collecting prior to our expenses. So a couple things that we need to hash, and I just want to make sure that you guys have a disclaimer that these are my numbers. This is the way that I calculate cash flow. So typically what I do is I take 10% for maintenance. So $217.50 a month. I'm gonna calculate this to be maintenance reserve. Now, there are going to be areas, certain areas in town or county or even in your state that you may have to bump this up a little, right? And the reason being is that certain areas tend to be older, right? You have older properties, or you know the property's out of shape. It's been around for a long time. You may want to bump up the maintenance because older properties tend to need more care and love, right? That's what I like to say. So you want to bump this maintenance up if you're dealing with an older property. So for now, I'm just going to keep it at 10%, which seems to be the average number. We're also going to factor in 10% for management. Now, a lot of people tell me, well, Sam, I'm not paying a property manager. I'm just going to manage it myself, right? Now, props to you if you choose to go down that route, but you have to monetize your time being spent on the management, right? Because if you currently, let's say you're working at a job and you're making $25 an hour, let's assume, okay? If it takes you 5 to 7 hours a week to manage, that's anywhere between 125 to what, 170, 200 bucks, let's say. So you have to ask yourself, is $200 of your own precious time worth the management when it costs you $17.50 more to have someone else manage it, right? It's one of those things that you have to really consider. What do you value more? Do you value time or do you value your money? Now, if you want to save that $217 and pay yourself to management, awesome, right? That's fantastic. If $17.50 is worth spending your time on management and the stress, right, the emotional weight that comes in dealing with tenants, that's all powers to you. But if you want to defer this to a professional property manager who can do it in a 10% fee and saves you time, that's what I would do, right? I would take the extra time, that the 5 to 7 hours or how many hours you're spending on management, and taking that time and going out to do more real estate deals. Because we're real estate investors, right? We're not property managers. We want to go look for more deals and do more deals with the amount of time. That's a little explanation I give you guys. We want to calculate 8% as vacancy. So let's see here, 20. So about $170. Okay, and this is vacancy. Now I am running out of room in the whiteboard, so I'm going to try to condense it down as much as possible. Now here's another. Now, Savvy, do you have to figure monthly taxes for all 3 properties?
I have the yearly taxes, which are kind of low.
Okay.
So the taxes it's $430.
$430 a year?
Yeah.
For each property or the whole shebang?
For each property.
Okay, so that's $1,200. Oh, okay, so let's call it $100 a month, right? So this is property taxes. Okay, we need to make sure we keep our firefighters and police officers in their job, right? That's what the property taxes do. Do you have the figures for insurance?
I got $75 a month because they're condos when I was doing
all 3 of them, or just each?
Each. Okay,
so that's going to put us at that's $2,200 or $2,250, yeah. 220. Well, I'm just going to put $225 a month. Makes it a lot easier. So this is insurance. Again, I'm running out of space. Taxes. Now, because these are condos, we have to make sure we put in HOA fees in there. Do you know what the HOA fees are for each of the condos?
$250, but that pays for maintenance and utilities.
All the utilities?
Water and sewer and
okay.
some electric.
Okay. So $250 for all 3 or just individual?
And I think, for my knowledge, individual.
Okay, so that's worth $250, $750 a month. So here's the challenge with that. Your biggest expense is going to be your HOA,
mm-hmm.
right? Right there and there, that could be killing the deal. So, well, let's take a look, because I'm pretty sure, I think we might be over the gross rent. I think you're going to be at 100% expense. Let me check. Let me pull up my calculator. Let me go get my cell phone real quick. Okay, I got my calculator. There we go. I'm gonna start with 21.7. So if you guys want to do the math with me, you guys are more than welcome to. But 1271 minus 217.50 minus another 217.50 minus 170, 100, 225 minus 750. So your net operating income is actually $495 a month. Okay. Now, this may still work as long as your debt service fits underneath the $495. What I mean by debt service, that's your loan payment, right? So if this is on a let's say a 20-year or 30-year mortgage, you'd have to basically be able to fix the cost so that it fits underneath that NOI, the net operating income. If it does not fit under that net operating income, that means we don't, either the rents are too low, okay, that could be a possibility, or this is just it's not a good deal, right? Yeah. So how much is the asking price per condo?
$44,500.
So 44,000 piece?
Yes.
Okay.
But he's open to negotiation.
Okay. So let's call it at 44,000 a piece times 3. So they're asking $132,000 a month, which I'm going to plug it in to see what it looks like on an amortization, like a mortgage calculator.
Okay.
So let's see, 135,000. See, we do 20% down. So even with 20% down on I got to put it in a 20-year. So on a 20-year amortization, okay, we're looking at $654.46. If you put it on a 30-year fixed, you're looking at $515.61. So you're losing, with the 20-year amortization, you're losing about $60 a month. With a 30-year amortization, you could be losing about $10.
Okay.
$10 a month. So yeah, I mean, you're not going to cash flow, unfortunately, with the price of $44,000 a piece. Maybe you might have to bring the price down. Now, one quick thing before I mess with the price. The reason why I mentioned 20-year amortization next to the 30-year amortization is because I don't personally do 30-year amortization. I think it's a terrible idea. You actually don't build any sort of equity, not until 15-year mark or so. So generally, I stay away from the 30-year amortization. My philosophy is that I want to build as much equity and principal as possible to protect from any sort of market turn, right? I want to make sure that I'm protecting myself from a potential interest spike, or even just a global market downturn, right? And we're going to see it. This is inevitable. We're going to see a market correction again, because the market's going up right now. I mean, it's on a steep incline. You can tell the inflation rate's going up, interest rates are going up, unemployment is all-time low, GDP is strong. So our economy is doing really, really well, which you guys know, our economy runs on cycles, right? We always have highs and we always have lows. We have a bull market and a bear market. So if we're on a bull market right now, I mean, we're going uphill in the marketplace, what's going to happen in the next 3 to 4 years, right? We might see a correction. Now, I don't have a crystal ball telling you, hey, it's going to happen in 2 years, right? I don't know that, right? As much as I think I know certain things, I don't know everything, right? Hence why I'm always a student. I'm always learning new things. But it worries me to put things on 30-year amortization, because what if there's a market turn in 5 years and the bank has to call the note due? Or what happens if something happens in your life where you need to sell in 5 years or 10 years? The question now becomes, do you have the equity to be able to walk away from the property with net profit, right? So that's a little philosophy thing, right? I always choose to go down on a 20-year amortization. Some of my properties that I have are actually on a 15-year amortization to reduce my principal balance as much as possible for maximum protection of my investments. It's one thing to get into the deal, but it's another thing to stay in the deal and keep the money that you're earning, right? You guys will probably agree, protection is a big thing. Okay, now for the sake of just curiosity, I want to find out what happens if we lower the price, okay, to let's say $40,000 a piece, which gives us $120,000. So let's put in a $120,000 value at 20% down, okay, 4% interest. I'm going to put this on 20-year amortization. Okay. Actually, I'm sorry. The 20-year amortization on this, you're losing more than 150 bucks. I don't know where I got the 60 bucks there, but you're losing 150 bucks there. So with this price of $120,000 on a 20-year amortization, you're looking at more like a $580 a month. Now, does that help? It does not, unfortunately. Right? We're still over close to $85 a month. Now, could this be a good deal if you had, like, let's say, 1,000 units? I think so. The reason being is that let's say you have 1,000 units. This is just another way to park your cash. Now, we have to factor this as to see if this is even a good return. $500 a month of net operating income may not be worth the struggle of this. The biggest thing that's going to break you is going to be the HOA, right? Yeah, HOA is going to break you out because right now you're looking at a third of your expense is going to the HOA. You see that? Now, this will be a different story if you actually bought a single family or even a 3-unit apartment building. If you bought a 3-unit apartment building without the $750 month HOA, then yeah, actually the figures actually will look better, right? You might have higher property taxes, but that should justify the $750 not being there.
Okay.
Yeah. So overall, this could be a good deal if you had like 1,000 units and you can stop. You would use this more as a loss carry forward. This will be a great tax saving deal if you have like 1,000 deals, right? If you have 1,000 units, you're making a ton of cash flow. And if you're looking for a tax shelter, this will be an ideal deal. But for someone who's just getting started or someone who are they're building their portfolio and right now they're in an acquisition phase, this really wouldn't make sense to do the deal if that makes any sense.
Okay, cool. It's good to know.
Yeah, so there we go. We have a pretty good breakdown of, and unfortunately, this will not be a good deal for most individuals unless you're watching this webinar and you have close to 1,000 units, right? Which is, that's a lot. But I don't think anyone quite has 1,000 units just yet. That's an incredible feat if you can achieve that. That'd be awesome. All right, so let's see who's next up on the batter. Let's see. Okay, Shamir's got a deal, and I just caught the microphone here. Shamir, I believe I met you last night, so sir, I'm going to unmute you. 1 second. All right, Shamir, you should be unmuted. Can you hear me?
Okay. Can you hear me?
Yeah, I can hear you.
Okay, cool. Yeah, so this deal that I wanted to talk about, I already concluded that it wasn't at least a good deal for me. I just wanted to analyze it to see if I made the right decision and just make sure that for next time, maybe there's something I could have done differently.
Okay.
So I ran across a deal. It was a vacant house.
Mm-hmm.
and it belonged the person that was trying to sell it. It's her grandma. She died a couple of years ago. I mean, recently, but she had that house a couple of years ago.
Okay.
But she hasn't been living in there. So the house was built in like 1890.
Okay. Wow.
Yeah. So it was a pretty old house. Maybe 700 square feet at the largest. Inside was just unusable. Everything was a wreck. Everything was a mess.
Okay.
And the layout was poor. So based off of that, I figured like, this would probably be a complete tear down.
Okay.
And that the lot was pretty much the only thing that was of value.
Mm-hmm.
So the lot size, there was close to 5,000 square feet.
Okay. So let's get to this. Keep in mind, guys, the numbers are great. We also have to consider what your goals are. So Shamir, what would you say when you looked at this? What is the goal? What do you want to do out of this property?
So when I analyzed it, I figured the best option would be a wholesale deal.
Okay.
And so what I looked for was to see if the mortgage was paid off, which it was. I looked to see if they had any property tax that wasn't paid on it, or what was the property tax on it.
Okay.
And so I found out that they weren't paying property tax since 2016. So 2016.
So, real backtrack, going back to your goal. If you were to wholesale it, who would you wholesale to? Are you looking to wholesale to a rehabber, wholesale to a landlord? What would you want to do?
Well, I thought since if I was going to wholesale it, and they wouldn't get any use in repairing it, I was trying to wholesale it to someone who's going to build from scratch, yeah.
Yeah. So we're talking about a little bit more of an advanced strategy. Now, what did you say the lot size was?
It was close to 5,000.
Okay. So the challenge with that being is that the lot size isn't that big. So you pretty much, I mean, I'm not sure where this is, and don't mention it because we want to keep all information secret and private. So it depends on the municipality. If you can get a rezone, I mean, it's small, but if you can get a rezone for, let's say, 2 to 4 unit thing, it might work. But seeing that the lot size is really small, I don't know if it's going to accommodate for that. You're looking at more. This will be suitable. Basically, it has to be a tear down and rebuilt, unless if the structure is good, you can still do a full gut rehab. Now, you said your goal was wholesale, and I'm sure some of you guys watching the webinar, you guys may have a similar goal of wanting to be a wholesaler to get started, right? Now, what's really funny, and this is almost like a paradox to wholesaling, is that when you're a wholesaler, you kind of have to be good at fix and flipping to wholesale. I know this sounds funny and weird at the same time. And the reason why I say that is when you're wholesaling, basically you are going out there looking for a niche source of where you can find the hottest deals, right? And the only demand, if you are a wholesaler, if the only value that you provide is that you provide good quote unquote product, right? I mean, you guys are consumers, so if you bought something and you guys end up buying something that's a low quality or it doesn't provide the result, or you find out you're shopping and you find out a certain product doesn't deliver, then you probably won't buy that product again. Much like so, as a wholesaler, you need to be able to find out what is a good product, right? And when I say product, I'm talking about deals that would generate profit. So in order to determine if the deal is going to generate profit or not, you yourself have to kind of be in that fix and flipper's shoes and determine how you came about estimating the profit, how you came about estimating the repairs, and how you came about understanding how the ARV after repair value plays into the deal. So all in all, wholesaling may seem like an ideal starting point for a lot of beginners, but actually, if you want to make good money from wholesaling, you almost have to kind of be a fix and flip expert or buy and hold expert to determine if it's a good deal or not a good deal. Does that make any sense? So it's a question of this, right? If you are a wholesaler selling me or selling me a contract to a deal, how do you know if it's a good deal, right? And this isn't I'm not pointing out to a specific individual, but this is everyone, all the wholesalers in the planet of United States, okay? So you have to understand if you want to wholesale deals, you have to know what is a good deal. So you pretty much have to be an analysis expert, and you have to justify why it's a good product. So going back to this deal, let's assume that this is going to be we're going to wholesale to a fix and flipper, right? So Shamir, how much was the seller asking for?
The seller wasn't, I didn't get to that point, I guess. I didn't ask what the seller was asking for. They just were motivated. They wanted to get a deal done as soon as possible.
Okay, but what price were they asking for?
If I remember correctly, they were trying to walk away with, I think it was like $40,000 or something like that.
$40,000?
Yeah.
What's the? Do you know what the ARV is? What it's going to be worth when it's fully rehabbed and fully furnished, or I should say fully rehabbed? Just rehabbed.
For that size, if I looked at it, because it was about 700 square feet.
Okay.
If we were doing a rehab versus a total gut job from scratch.
Yeah, it's pretty much a full gut job. So if we were to transform it to where it's going to look really nice, it could be marketed through a realtor. How much do you think the property is going to be worth after it's been full gut rehabbed?
If it was full gut, you probably could get for about that size, maybe like around, I don't know, 70.
70,000?
Yeah.
Okay, so here's the dilemma, right? If they're asking for $40,000 and you're trying to gut rehab and sell it for $70,000, there's almost zero profit margin here, right? So, and here I'll justify that, right? So let's say the ARV is $70,000, and I can neither confirm or deny if that's true. So for those who don't know what an ARV is, it's after repair value. You typically determine that using comps, and we'll go over this in another segment. But let's say after we're done rehabbing it, making it look nice, we can market it. Shamir says $70,000. Now the challenge is when you sell it with, let's say, a realtor, you're going to pay a 6% commission to the brokerage, right? On top of that, you're going to have to pay the closing agent 2% of the title, right? The title company 2%. So you're going to really look at paying about 8% just to sell it, right? It's just selling costs. We can't avoid it. So the selling cost, let's assume, is 8%, which means 70, 50, 53,000 around. I'm just going to guesstimate and say 53,000. I'm sorry, 5,300. Okay. That's how much it's going to cost to sell it with the broker. Okay. So that's an expense, right? We have to rehab it. If it's a full gut rehab, I mean, it may actually cost upwards of $50,000, $60,000 to do it, right? So it may cost $60,000 to rehab. Okay, you're gonna have holding costs, meaning you're gonna have to pay for utilities, the property taxes, insurance, the whole 9 yards, right? Now, a full gut rehab typically takes more than 6 months. Okay, you're gonna be. I mean, if you're fast, baby. But what I've noticed, 6 months of gut rehab, and you got to give yourself 6 months to market it and sell it. Okay, so we're gonna say $5,000 on holding, right? And I'm also including property taxes, utilities, insurance, and so forth. We're also gonna have to put in what I like to call a hedge cost, and this is basically a cost associated to, let's say we open up a foundation, we found out that there's a major issue. So I usually like to calculate 10% of the rehab budget as the oops cost. Okay, so if you do the math here, we're well over the ARV, meaning it will cost more money to just to put this back together than to sell it. We're probably going to be negative like 30,000 or so. So if you show this to a fix and flipper, obviously they're going to be shying away from it because there's no margin there. If it's totally destroyed and completely trashed, and I'm not saying this in a way that is offending the seller, or I'm not saying anything bad about him, but by asking $40,000 when properties like that could be sold for $70,000, it sounds like they have a pipe dream. Okay, and I'm just gonna be blunt and say that they have a pipe dream of wanting to say, hey, this property, we're gonna walk away 40 grand, but there's nothing in there that could be restored, right? So honestly, I'm gonna be if I was the investor in this deal, I'm gonna be very blunt and just be like, hey, you might as well just give this property to us for free. The more you hold on to it, you're gonna pay utilities, you're gonna pay property taxes, you probably have some code violations, so that alone is gonna be like 10 grand to fix it. You know, you got a bunch of issues. You might as well just give it away for free. Deed it to me for free. I'll pay the legal costs, and let's get the show on the road. So if the asking price was, let's say, even zero, okay, it still actually would not make sense because your rehab cost alone is pretty much what the property will sell for. So again, you're going to be at like negative 5,000. So pretty much they're screwed. I hate to say it that way. The sellers are pretty much screwed because even if they put it back together, the value isn't there. Now, that's still questionable from the ARV. If the ARV is absolutely accurate, yes, this is a shot deal. But if the ARV determined by an actual statistical and verifiable proof that the ARV can be higher than the $70,000, maybe there's a deal. But as it stands, it appears that there's no deal here from the fact that the ARV is too low. They're asking way too much, and for a full gut rehab, yeah, you gotta estimate high. And I hate to put it this way, but a lot of times contractors will tell you, oh, 50 grand. They'll actually end up using like $75,000 because, oh yeah, there's something happened, right? They'll always come back and tell you and give you an excuse as far as why it's taking more money to rehab the property. I mean, this has always been the case for my properties. Even with my rentals, right? They give me a bid for $2,000 and they charge me $2,600 because like, oh, well, boss, I had to go run extra wires or whatever. So it'll be like that. So yeah, Shamir, I'm glad that you walked away from it because unfortunately, this is like 1 out of a million thing. You find a deal within the numbers. Maybe I don't know something. I'm just giving you guys my opinion. But it appears that there's no deal in here.
Okay, yeah. I mean, I came to the same conclusion. I was like, this will probably, you have to give it to us for free for us to even do something about it. And I could even think of a way from there. So that's okay. I was just trying to confirm to make sure that I made a good decision on that. Yep.
You're good to go, sir. So yeah, thanks for participating. Thanks for giving us a wonderful example there. And I appreciate participating in the webinar.
Thank you.
Yep. All right. Anyone else? Let's see. Anyone else would like to share? I think we got time for, you know what? We got one more. Like we can squeeze one more and then we'll head to a closing statement. Are you guys having fun? I mean, this is fun for me. I don't know about you guys. You know, I probably won't be able to do this forever, but I'm having lots of fun doing this in a webinar form. So anybody else that can squeeze probably 10 more minutes of analysis, anything? Yeah, we can. This is a free format. This is for you guys, not for me. Anybody else? So let's do this. Do you guys have any questions in regard to the last two deals that we analyzed? If you guys want to go back to asking any question, whether it was shared from Savvy or from Shamir, any questions about why I concluded to be not a good deal? Any conclusion as to how it got to certain numbers? Anybody? I mean, we're here till 8, so unless you guys want me to end it early, I'll be more than happy to do that. So, anybody? Now, if you can't find the chat box, oh, we got something here. 1 second. So it says, so I can change the strategy and do it in a wholesale. In theory, you can. Now, wholesale, a successful wholesale, always depends on the demand of that particular property, right? If it's a good deal, yeah, you may be able to go attract a seller. Now, if you can manage to bring down the price, maybe, Now, even better, if you can hit the price and bring it to owner financing, then yes, you're gonna have people flocking to wanting to do that deal and want to take it off your hands. Now, the reason why I say, and I'm glad you brought this up, Savvy. The reason why I would mention owner financing is because very few bank institutions, and if there are exceptions, that's awesome, but very few banking institutions will fund a portfolio. Even if you give them a really good down payment, banks typically don't like to underwrite in an entire portfolio, simply from the fact that they have to go through all the statements, they have to go through all the figures. It could be anywhere between 3 to 5 months for them to even fund a portfolio. So it's going to be increasingly difficult for anyone that's willing to sell, let's say, three condos in a single transaction. It's going to be rather difficult for that number to work. So ideally, what you can convince the seller to do is a seller financing type of deal where they seller finance the portfolio, and you may have to beat them up on the price because you're not going to get cash flow out of this deal. Unfortunately, the HOA is way too high. Like I said, the HOA could really be your number one enemy in that figure. So I think I've seen you write more things here. Let's see. My original strategy was on financing, but I needed to look at all the numbers. Yeah. So, yeah, you can potentially do owner financing. The HOA is definitely going to have to bring the purchase price down. It just doesn't make sense with the HOA being $750 a month. If it was $750 a year, yeah, it'll fly, right? There's room for margin. But that HOA is not our best friend, right? You're definitely gonna have to bring the purchase price down. And if you can get an owner financing, package it, put it under contract, and wholesale it to another buy and hold investor that can put down the down payment and owner finance it, awesome, right? I think you may have some profit there, but there's a lot of moving parts that you have to mess with first. Purchase price, right? The HOA being a problem, and you're gonna have to negotiate it to an owner financing and then wholesale it. So as you can see, there's like 4 moving parts there that you have to mess with. You have to ask yourself, is it worth messing with those 4 moving parts just for a quick wholesale check, right? Might as well you do the deal yourself if you're gonna do it that way. Alrighty, another question. Any other questions about the last 2 deals we talked about? Unfortunately, it both ended up being not so much of a good deal, but if you guys have any other questions, let's see. Yeah, I don't see any other questions in the chat box. I may want to buy a big TV screen with all the questions because I have to kind of walk over to the computer and see what you guys are saying. So anybody else, any questions, anything that, I don't know, you guys are like, hey, I'm curious as to how you got to that conclusion. Anything. Otherwise, I'll go ahead and wrap this up and we'll give you guys a little preview of what's coming up next. So I'll close it out. If you shoot me a question, I'll answer it, okay? You guys have my email, so you guys can always email me questions. So here's what I want to close with, and some of you guys are already participating in this opportunity that I want to present to you guys. As always, if you guys have been following us around on YouTube, if you guys have been following me on social media, Facebook, LinkedIn, you guys know that Daniel and I have a nationwide group of real estate investors. Now, you guys might be asking, how in the world did you learn, all that pertains to real estate investing, right? I mean, I have to say I'm incredibly blessed, right? I couldn't have done it by myself, and my brother would say the same. So my brother and I, Daniel and I, we actually got plugged into a nationwide group of real estate investors that taught us how to negotiate, taught us how to raise money, right? In the last 3 years, my brother and I were able to raise over $10 million of private capital. We were also able to go out and find deals and work with mentors and coaches. So this nationwide group were the ones that really helped me out. Savvy is part of that group now. Shamir is about to get involved. I know several of you guys in the list are already involved. So for those who are not involved in this nationwide group where I learned how to invest in real estate, and I got started 4 years ago, and you might notice I am young, so I couldn't have had 20 years of knowledge, right? But I got started about 4 years ago with this nationwide group. So if you guys are interested in working with this nationwide group that I'm working with and get plugged in, go ahead and send me an email saying that you're interested in working with my group and myself. we're building a community, right? Like an ecosystem. You know what? Let's do this. I'm gonna bring Savvy because she got started like last week or two. Savvy, would you be open to sharing what your experience has been so far working with this group? I know you're brand new, but would you be open to sharing maybe about 30, 40 seconds of what it's been like so far? Anybody? Or
Yeah, sure. I enjoy it. I really like the group. I love the community. They're very, very supportive. I can actually, call and say, hey, I have a question. Or, hey, can you guys look at this? There's practical information. And I'm really glad I found this group because I found a previous group and I ended up getting charged like $73,000. And I have a phone number. And I can't really reach out
that's a problem.
to my mentors like I would like. So I'm really glad I found this particular community because it's so personable, and the information, the education, the things that you learn is practical. You can like implement it right away, which is awesome.
Yeah, and thanks for sharing that thought. And I share the same sentiment as you do. I got started 4 years ago, and you got started like 2 weeks. So it's nice to have that similar perspective on this amazing group that we work with together. So what's nice is that Savvy's from Atlanta, I'm from Chicago, and this nationwide group is truly nationwide. I mean, we got offices and locations everywhere. So if you guys want to participate, if you guys want some more info on how you can get involved, simply shoot me an email saying, hey, I'm interested joining you, Savvy, and soon to be maybe Shamir, right? Then send me an email. I'd be more than happy to send you guys some more information about it. By the way, this will be recorded and put on our YouTube channel. So if you guys have not, please do subscribe to our YouTube channel. It really helps us to go and create more content. Of course, if you guys stop subscribing to us, then there's no reason for us to go make more videos, right? So please do subscribe to our YouTube channel. If you guys are watching this on YouTube, for those who are watching the recording, we will have fresh new contents almost every week. So this will be uploaded on YouTube for those who are watching live. So guys, I'm going to close it up. If you guys have any other questions, you guys know where to reach me and find me. Thank you so much, guys, for tuning in and joining in another deal or no deal webinar. We will do another one in about 2 weeks. So I try to do these on every other Tuesdays. So if you guys want to come on board the next time we do it, go find a deal, right? Go find a deal, bring it back, and we'll love to share my opinion and my thought about whether if it's a good deal or not a good deal. Thank you so much, guys. Appreciate your time being here and being in the audience, and I will see you guys next Tuesday. All right. Ciao, guys.